Welcome to the ETFatlas.com, the ultimate destination for ETF enthusiasts. I'm thrilled to have you join us today in this exceptional space where we house the world's largest ETF database, over 10,000 ETFs in one place, covering those domiciled in the United States, Canada, and Europe. Today, we have a very special guest with us, so let's dive right in. To kick things off, I'd like to introduce our esteemed guest, Andrew. Could you please tell our listeners a bit about yourself and your role in the world of managed futures?
Thank you very much. Thanks, and thank you for having me on. So my background is I've been in the investment business for a very long time. I started as a hedge fund manager, started my own hedge funds in the 2000s, and really did a pivot in my career. And what I've tried to do over the past 15 years is really try to find strategies that are valuable not just to the institutions and large family offices that have historically invested in hedge fund strategies, but rather find ways of bringing those to a broader audience. About 10 years ago, my partner and I started to look at the managed future space. And what we concluded, and we'll talk more about it, was, for a wealth manager or an individual who's seeking to diversify their portfolio, but cares about liquidity and access through, client-friendly vehicles like ETFs, we thought managed futures was probably the single most compelling or valuable way of bringing some of those diversification benefits to a portfolio.
Thank you, Andrew. So now let's delve into some questions about managed futures so everyone will understand the whole idea. Could you explain what managed futures strategies are and how trend following fits into this broader category? How would you describe managed futures to an investor who's never heard of them before?
Sure. So the term managed futures is a little bit complicated because you say it doesn't really mean anything. If you say, value stocks, that means something. If you say private credit, that means something. Managed futures really describes a way of investing that has been around for 50 plus years. What makes it unusual is that there are not many investment strategies that have worked for 50 years, and managed futures is one of them. So when I describe it to people, I say, just to take a step back, this is a proven strategy that's been around for a very long time. That's it's worked during the most important market periods where you've really needed that diversification. What managed futures does, and the way that I describe it, is that most investors are going to have exposure to stocks and bonds, and that's easy, right? And almost every wealth management portfolio will give you some exposure to that. The question is, what else do you add to it? And what managed futures does is it tends to deliver the best results when the other parts of your portfolio are not working well. And so the whole idea of diversification, like why do people talk about diversification, is because you could do perfectly well if you just owned one stock, just buy one stock, but the stock could do incredibly well or could do incredibly badly over time. For most people, for their personal wealth, that's too risky. For institutions that are, have a pension plan, that's too risky. So the whole investment business is built around bringing more and more things into your portfolio. The whole idea that different things are working at different times. And what makes managed futures unusual is that it has tended to work the best when everything else is not working well. And it's based on a very, very simple idea that's been true for a very long time, which is that sometimes the world changes, and it changes a lot. Now, a typical asset manager will tell you, no, change is great because we're going to see the change coming and we're going to find out a way to make money for it. It's going to be a great benefit to us. But the reality is most portfolios don't change, and they don't change much. So think about when you hear people talk about I've got a portfolio, a 60-40 portfolio of stocks and bonds. They're telling you that they're never going to change. That what works today is going to work exactly like as well in 10 or 20 years. And so, in fact, what we see is that, yes, things like that can work for periods of time, but there are times when the world changes when you really want something different in your portfolio. And at the core, in terms of what it does, managed futures delivers those benefits, which is why we got into it and said, you know what, let's try to find a way to bring those benefits, but not in the way that institutions may invest or high net worth investors by paying a lot of fees and going through these vehicles, these funds that are very difficult to access. Let's try to find a way to get those benefits and make it available to a broader group of people.
Right. There are many flavors of managed futures, and one of them is trend following approach. What makes trend following so important, or at least I think they are important within a managed future space, and how does it contribute to the overall strategy?
Sure. So you can think of trend following as like the beta of this space, and by that I mean, if you're a 30-year-old person and you're investing some money and thinking about, how much money you can have in 20 or 30 years, in general, people are going to say, put your money into stocks. Then the question is, how do you put money into stocks? You could invest in a low-cost index fund. You could try to pick a stock yourself. You can buy meme stocks. You can, a million different ways of doing it. But nobody argues about whether stocks themselves are a good investment. And in a sense, a lot of active managers, if they came to you, what they would say, if they were honest, is you're 90% of the way there by just being in stocks. We're going to make it a little bit better at the margin. So trend following, what trend following is, it's an investment strategy that basically says when the world starts to change, it sometimes changes much more than people expect. When inflation came back, it didn't go from 0 to 1%. It got up to 6, 7, 8, 9%. It went and it kept going. When the great financial crisis happened, it wasn't, one bank that collapsed. The whole banking industry sort of collapsed. So what trend following is basically managers who look across a broad range of these financial instruments called futures contracts. And futures contracts are very simply just a way of getting exposure to things that are often otherwise more complicated to trade. So for instance, if you believe oil is going to go up, I don't know of many people who would go out and start filling barrels of oil and putting them in their backyard and hoping they're worth more. You buy futures contracts on oil, right? Heating oil, even things like 10-year treasuries, if you believe they're going to go up or down. So what these managers do, and it's a very valuable service, is they're constantly looking at the price movements across lots and lots and lots of different futures contracts. But really what they're doing is that it's almost like an earthquake detector, and they're trying to detect slight changes of in these prices that are telling us that the world is changing. And so in the fall of 2020, before people were really talking about inflation coming back, these guys could see signs of it. Now, why is the interesting question? Because there are smart people out there who will get it right. Let's say the world changes completely in the next 3 years. And there are people who will get that right. But what do you do if you have that piece of information? You don't go on podcasts to tell people about it, right? You don't write articles about it. You find a way to make money on it. And what happens is, if it's a good idea and you and other people are doing it, you'll see changes in prices. So changes in prices is one of the most valuable pieces of information we can get. No stock picker analyzes a company and says, I love this company, but I don't care what the price is or what's happened to the price. If the price has just gone up 5 times over the past year, they're going to be much more concerned about whether it's overpriced. And if it's gone down 80%, they're going to wonder what's wrong. So analyzing prices is very, very valuable, but precisely because it can give you insights into how the world is changing, because that's the risk we face. And today, I would say it really feels like the world's going to change a lot.
Yeah, and we'll touch to that topic as well soon. I wanted to ask you, are managed futures maybe then considered as a separate asset class? Because you mentioned about stocks, you mentioned about bonds. But also you mentioned about adding managed futures. Can we then consider them as a separate asset class? And also, if so, are there maybe some specific benchmarks like we have in the case of equities or some indices that represent managed futures?
So I think managed futures should be its own standalone allocation. So it's interesting. It's a historical accident that managed futures ended up in the hedge fund space to begin with. It's not where they started. They were products that were offered to high net worth investors. You could have daily liquidity. They tended to be extremely expensive and extremely volatile. But the origins of it was not in the hedge fund industry. That only started in the early 2000s when institutional fund of funds started to adopt this as a strategy. And then it became a hedge fund strategy within the hedge fund bucket. It doesn't make any sense. You put your money into hedge funds for your for your audience. I mean, hedge funds are really just a vehicle that they tend to be less liquid than a mutual fund. You tend to put your money in once a month, once a quarter. It can take a while to get your money out. But the whole point of it is, for certain strategies, it's better for the manager not to have to worry about money coming in and out every day. Like private equity, you can't buy a private company and have people buying and selling shares every day. And so hedge funds, that benefit is valuable for a lot of hedge fund strategies. It has no value in managed futures because the underlying itself is so liquid. So my argument is actually that as the world is moving from 60-40 as a standard portfolio, in 3 years, we'll talk about things that are more complicated. So 50-30-20, right? Where 50 stocks, 30 bonds, and 20 other things. And, those other things may be things like private equity. It may be things like managed futures. But within that, there will be 5 or commodities, maybe inflation protection. There will be 5 or 6 different things that will fill that 20%, and one of them will be managed futures. And the reason for it is that it's very unusual in that just when people build these diversified portfolios, they use a lot of statistical tools to try to figure out how do we help you make as much money as we can and help you sleep at night. So how do we maximize your risk-adjusted returns over the next 20 years? And in order to do that, you want things that are different, that diversification has great value. And it's also valuable, particularly in the wealth management world, when things are liquid and can be done in ETFs or mutual funds or UCITS funds. So managed futures is relatively unique in that it's got great diversification benefits and you can make it accessible. And so I believe that because of that, it will become its own standalone allocation, where you're sitting across from a client and you'll say, these are your stocks and we've got it across all these different markets. These are your bonds. We got all these different markets and different credit ratings. And here's your other category. And of that 20%, 3% is your trend following or your managed futures allocation. And that helps to make the whole portfolio more robust.
All right. So from what you are saying, you are actually looking on managed futures as a complement to a traditional portfolio rather than an independent strategy. But I also see some dogmatic, let's say, persons, I will not name them, but who would have only exclusively managed futures in their portfolio, like trend following and no other assets in the portfolio. What do you think about such approach?
Look, so I think people can put into their portfolio whatever they like. Managed futures and trend following to me is interesting in that, as you can tell from my background, right? I came into managed futures because I concluded it was a great investment strategy that I thought we could deliver to and help investors. But there are also people who view it as almost like the way the crypto people view crypto. There's something in it. There's some secret knowledge in it that they feel is very, very special. Now, the long-term diversification benefits of managed futures are great. They are undeniably great. But on a risk-adjusted basis, there are a lot of things that are great. Equities are great. Private credit has been great. Private equity has been great. There are a lot of different things. It doesn't stand alone. What we do know is for the typical investor, whether that's an institution, a high net worth investor, or a retail client, is that they're looking for a balance between return expectations and volatility. And they're looking to be able to sleep at night. It's much worse for, and that gets even more so when you get down into retail investors, because if you're an advisor and you've got 200 retail clients, or $1 million, $2 million, $3 million clients, if you lose half their assets, you've ruined their lives. Right? You have a responsibility to help them not go back 20 years. And not to force them to work for 20 years longer than they want to work because you made a big mistake for your portfolio. So my argument is that for the typical person who's advising those clients, it's their job to be balanced. It's their job to be diversified. And so when you come to them with a tool and say, we can make the whole picture better, it's almost their responsibility to take it seriously and look at it. Now, with managed futures, the interesting thing is very, very, very few people who fit that model have actually done it. And there are reasons for that we can talk about, but in a sense, you are asking people, you are taking one of the best arrows out of the quiver from a diversification perspective. And usually it's because the advisors themselves never really took the time to understand it, or the people who were explaining it to them didn't do a good job of helping them to understand not just what it is and what the benefits are, but why it's good for their clients and how it's going to make their clients' lives better. So that's really where we look at this as, yes, it's a great investment strategy, but practically, how do you help the advisor community bring this thing into their portfolios in a way that makes their clients happy, which is good for them and their business?
Our main reason why we are talking about managed futures is that there are now ETFs available, giving us exposure to that asset class, to that type of strategies. And that's why I wanted to ask you about your ETF. What were the key assumptions behind creating the DBMF ETF? And do you believe that, similar to how John Bogle impacted the mutual fund industry decades ago in the 70s, DBMF and similar ETFs could revolutionize the hedge fund space by offering more, let's say, affordable access to managed futures strategies? And I think mostly here about retail investors.
So it's a good question. So I think that, and there are a few parts of it. So one is, I by the way, for compliance reasons, I can't talk really about specific products.
Sure,
so I'll talk in general about what we were trying to do. You asked a question before about, if you were going to look at this space, what benchmarks would you use? How would you evaluate it? That is a surprisingly tricky question in this space. So what I would say is that if you are a typical institutional allocator, there is an index called the SocGen CTA. It's a hedge fund index, but it's called the SocGen CTA index, which has probably the best data on the space. There's another database company called Barclay Hedge, which has a similar data set of data. Theirs actually goes back even farther than 2000. And so most allocators, when they're trying to decide how do you look at an index of its space, the S&P 500, because it tells you, how has that index done over the past 10, 20, 30, 50 years? And that gives me some assumptions as to how it's going to work going forward, which then helps me to decide, do I think this is a good investment for my clients? Now, so you need something that's broadly representative of the asset class or the strategy. And so what those indices that I mentioned are basically the average returns of the 20 or more largest hedge funds who've been in that space. And it does give you very, very good information as to how, okay, this is how it did. It went up during the great financial crisis. Why did it go up? Okay, does that seem like a reason that why it would go up in 2022? Well, look, it went up again in 2022. So that information is very, very valuable, but it's not practical unless you can invest in those hedge funds. So an institution can use that data and decide, let's build a portfolio of some subset of those funds to try to give us what that index can deliver. Outside of that, outside of being able to do that, you can't really do it. So over recent years, they've been like Morningstar has a category average of all the mutual funds that do it. There's some other indices that have popped up. But what we basically said was we want to try to figure out a way to create almost an investable version of the space. And so in a sense, it was almost kind of sitting between passive and active. A truly passive strategy would be to go to all those hedge funds and say, we'll give you each $1 to invest in, and we're going to charge, you're going to reduce your fees or something, and we're going to help. And basically that's going to be your index-like way of getting exposure. That's not the way they operate. So what we basically said is we think we can use that kind of broad data to figure out their most important positions and come up with a pretty good estimate of the overall space, pretty good return profile. So if they go up 20% in 2022, can we be up around 20% with the same drivers of returns? Would we have been able to do the same thing during the GFC? And the way that we get there is not by copying what they do on a day-to-day basis, but by something called replication. And replication is basically trying to synthesize, using recent data, try to synthesize what they're doing down to a simple portfolio. And the simple portfolio is they might, some of these firms will invest in 100 or 200 individual futures contracts. We synthesize it down to 10. And the reason, and it works far better than most people would expect it to work. So you end up with a correlation to those hedge funds around 0.9. So it's not 0.99, it's around 0.9, but you do get something that looks and feels a lot like what the big hedge funds out there are doing. The reason this matters is because it's a lot easier to take that simple portfolio and put it into an ETF, put it into a UCITS fund, put it into a UCITS ETF. So the idea was really, back to the point about Vanguard, what Vanguard was, the similarity is that we believe that most allocators, most of the time, are looking to get index or index plus exposure to the space. That if you think about somebody building a portfolio and they've got 15 different categories, the first job is how do you decide how much you want in each of those categories? And my argument is managed futures will be 3% of the 100%, maybe 5% if you want more of it. But then how do you fill each of those buckets? And your starting point is something that's index-like. So if you're doing that with equities, right, and think about what Vanguard did for equities. If you're doing with equities, you say, well, do I just want the S&P 500? Or incredibly cheaply, or do I want to pay somebody a lot more to try to beat it? Decades and decades and decades and decades of data says you really want the first more than the second, unless you feel really good that you can find the person who's going to do that. Now, statistically, you're not going to, we know, but a lot of people are in the business of trying to find that person, and they'll keep doing it. And there are psychological reasons to do it. It's hopeful. You hear somebody who seems to do better than average. That's great. So what we were really trying to do with this space, which as I've mentioned, is sort of hard to get access to in the way, is find a way to create a new access point to it for people who weren't going to invest in the space to begin with because of these other issues.
So please correct me if I'm wrong. You're not trying to be the best managed futures fund out there, but you try to deliver the average of a basket of funds wrapped in an ETF package, right?
Right. So we try to, so here's what's sort of interesting is we try to deliver the average cheaply,
right,
efficiently. And so the way that I describe replication to an allocator is, and what I liked about it as somebody who wasn't a quant, right? I didn't get out of business school and go decide that I wanted to be a trend follower and kind of grow up in that world. What I liked about it is replication. The way that we do it is a systematic, repeatable investment process with structural alpha, right? That means you have the wind at your back. What is the wind at our back? What we do is very efficient. What a typical trend follower or CTA does is a lot less efficient. You need a lot more people. You're trading a lot more instruments. Your trading costs tend to be a lot higher. And so when they implement their investment strategies, their trading costs will be high. They have investors who are used to paying higher fees, not ETF-like fees, but hedge fund fees. So they might charge 200 or 300 basis points a year when you get through management fees and incentive fees. You take all that together. When we're trying to replicate what we're doing, we're not trying to replicate what they're doing after all those fees and expenses. We're aiming for what they're doing before. And so our argument is that what makes replication similar to something like so if you do the analogy with the S&P 500, right? If somebody said, what we're trying to do with the S&P 500 is just give you the average stocks that all of those active managers are investing in, and they're charging you 100 basis points. Well, we can just give you those average stocks for 10 basis points. The argument is that 90 basis points of difference, maybe plus even some additional lower trading costs, is going to be more valuable over time. Those fee savings are going to be more valuable over time than the person who's trying to pick which of those 500 stocks to own. So what's been disruptive about replication is it's cheaper and outperforms. But unlike a true S&P 500, it's got a little bit more of an it feels more active because we have to rebalance every week. We're trying to keep up with what they're doing. Our variation with what they're doing is going to be higher. But the ethos is very much in line with, a low-cost way of getting exposure to the space is often just a better investment outcome than trying to pick which of those funds will be the best.
By the way, I recall you once said something like that the purest form of alpha is the cost reduction. I really like that.
Fee reduction is the purest form of alpha. Yeah. I mean, yeah. And there are assumptions underneath that, right? I mean, and by the way, so what confuses people about it, I've been very vocal and negative about the average hedge fund fee. And in 2016, I wrote an editorial for the Financial Times, which basically said, so in general, hedge funds make 10 before fees and clients get 5 after fees. So that 5 better be really valuable in order to justify the fees that they're paying. And the reality is the 5 that you're paying actually consumes most of your alpha. Right? So the best stuff that you're paying them for, if you're overpaying, the alpha goes to them, not you. So ironically, actually, and this is what big institutional investors in the hedge fund world learned 10 years ago. Don't just take the headline fee, right? I mean, negotiate your fees down if you have a lot of money to invest in hedge funds, don't pay the headline fee because it's a bad economic deal. And so this is what they will do in the managed future space. They will go to the flagship funds and they would say, look, I can give you $500 million. But no, I'm not paying you what, that family office is paying when they give you $2 million. And they do better, right? It's the right thing for them to do economically. The investor with $1 million who's invested in an RIA does not have that leverage. The investment advisor does not have that leverage. Very few people have that leverage. So we're trying to give them that leverage, but in a roundabout way.
Right. By the way, I even once was reading that before launching the first index fund by John Bogle, he calculated the average return in the mutual fund industry. And the difference between the index and the average of the mutual funds was just about that fee, which were taken by the funds. So that's how he could convince to launch such a product, because I mean, just launching the product which gives the average result wasn't very convincing at the very beginning.
Well, I have something interesting to say to that, because I'm always fascinated by the psychology of of the investment business. And this goes back to, I've always said that the hedge fund, what I liked about the hedge fund managers, what I liked about private equity guys, is that they were behavioral scientists before behavioral science was a thing, before people published papers on it. Because they're always trying to examine their own decision making, and they recognize that we have all these flaws in our decision making. So here's the fascinating thing about the manager selection process, whether it's mutual funds or hedge funds, is what are the questions you want to know from the hedge fund manager? What's your information edge? What do you know that nobody else knows about this? Show me your track record about how the stocks that you've picked have done better than the average stock over time. That you ask all these questions looking for it. And then if you ask the same question back at yourself, what information do I have about that mutual fund that nobody else has? Nothing. Okay. You have their track record and a fact sheet. You have no advantage over the next person looking at that fund. What evidence do I have that the track record that they have is going to continue? Well, of course, you're looking at them now because their track record has been good recently. Which fund would you ask yourself the same question? Which fund would I have picked 5 years ago and 10 years ago doing the same analysis? And so the great paradox, and this is true, this is back to the point about John Bogle, is that the fund of hedge funds industry, professional investors who walk in every day and say, who are the best hedge funds out there? And that's a hard area to invest in, and we're going to find the best hedge funds, have done worse than their fees relative to the actual hedge funds. So the great irony, if asset allocators and advisors are honest, is that there really is no edge in picking. And yet people still do it. Why? Because sometimes it's what they're expected to do. They took a job where their job is to pick hedge funds. They will keep picking hedge funds until somebody tells them they don't have a job anymore. And so, but as an investor, right? As somebody who's really thinking about how do you help your clients to grow their money the most over time, think about, where do I really have an advantage? As an allocator, where do I really have an edge? And you can have an edge on asset allocation. Like, that's something where real judgment comes into it. What strategies do you think are going to work over the next 10 years and why? And I mean, think about everybody building 60-40 models. And people are just starting to talk about this, okay? This is so fascinating. Think about the mistake that was made. We knew we were in the midst of the greatest bond bubble in history that had gone on for 20 years. At the end of 2020, in the middle of 2020, during COVID, rates were 0 or negative in a lot of the world. And your advisor kept rebalancing 40% of your assets into that. Into what some hedge fund managers were calling an uninvestable asset class. At the very, 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 very top of the market. And when the world starts to change and the evidence starts to roll in, they still don't change. Think about the magnitude of that economic mistake that they made. But they're not held accountable for it because their job was to put you into a 60-40 portfolio and to tell you that it would always work. It hasn't worked this decade. So where the effort should be on is, okay, 60-40 worked for 20 years. It's not working now. It's not going to work on a going forward basis. We need better tools for diversification. Let's have an intelligent discussion about what those are and have an intelligent discussion about the ways to get access to them without creating other problems and stepping on landmines.
All right. It's very interesting. I wanted to ask you a bit more questions about DBMF, if the compliance will allow us, regarding this, the replication strategy you mentioned before. Is it fully systematic, or does it maybe incorporate some discretionary elements as well?
So the way we do it, it's fully discretionary. And again, like, if I'm going to use the S&P analogy again,
Fully discretionary, you mean?
I was fully systematic,
All right.
non-discretionary. Sorry, zero discretionary.
All right.
Like think about the S&P 500. Part of the predictability of the S&P 500 is you know the rules by which they are going to rebalance, and they do it on a set schedule, and that that introduces predictability to it. From our perspective, when we set out to replicate the space, we wanted to build something that was systematic and would work then and work in 10 years and work in 20 years. That's how to us, that was how you could show that something is reliable and robust over time. So in our core replication models, we haven't changed anything in over 9 years from a modeling perspective. In one of our portfolios, we changed some of the factors. But in the strategies that we're most known for, which is where we use these 10 big liquid markets, we haven't changed a line of code. We haven't changed any of the factors we invest in. We haven't changed when we rebalance. In 8.5 years that we've had that strategy up and running, and that's part of my pitch to people is what's really hard to evaluate when you're looking at a strategy is when somebody comes in and says, let me tell you about all these changes I've made. The question you should be asking is not, interesting. Well, what are your favorite changes you've made? The question you should be asking is, why? Wait a second. What isn't working that you need to make changes? Why didn't you make these changes before? If these are such great changes, wouldn't it be? I wish you'd made them 3 years ago. Why didn't you make them 3 years ago? What were your best ideas 3 years before that? So constantly changing models is a huge problem for allocators, which should make them inherently suspicious of somebody who's coming in and talking about new developments. Now, you can do it at the margin, but the best answer is you build something that works and keeps on working. And in a sense, that's what I liked when I first looked at this managed future space. It's so counterintuitive. This is a strategy that worked in the 1970s and 1980s before people were using computers. Think about that. It was gut feeling from people who were trading, who were saying they'd see some prices move. And they'd see some prices move over here, and they'd see some prices move over there, and said, and what's the question they would ask? Somebody knows something. What do they know? And how do I figure out what they know? Or maybe I should just follow what they're doing because they know something that other people don't know, and that's what's causing the prices to move. and that still works today. It was the same thing in 2022. In 2020, the U.S. Treasury yield got to about 50 basis points. Right? So again, think about that. Everyone with a 60-40 portfolio, they're not taking profits on it. They're not saying, let's get out of treasuries because it's only earning 50 basis points for the next 10 years. Let's go put in something else. They held the positions. But then rates started to go back up. Right? And why? Because certain macro investors and then CTAs realized, the probability of inflation coming back is not zero. So they start to make bets on it and start to change the pricing. And then this is when managed futures funds pick up on it. And the fall of 2020, before people ever talking about it, they start shorting treasuries, betting on rates that are going to go up. Now, again, the rest of the world doesn't change. They're not built to react like that. So think about how valuable it is to have something in your portfolio that it's going to get it wrong a lot of the time. But boy, do you need it then. And for the next 3 or 4 years, you have something that when bonds were not working as a diversifier in your portfolio, you have something that was actually picking up some of the diversification slack that your bonds weren't giving you. And look, for the next 10 years, it may be equities. Equities could go down. I mean, the S&P 500 did zero over a 10-year period of time after having gone down and only came back to zero. The NASDAQ was down 40% over the decade. And then, of course, has gone insane since then. It could be equities. It could be that equities aren't being a driver of returns. You need something that's going to step in for it. Well, if equities go down 30, 40, or 50%, that's going to be, talking about trend, that's going to be a big trend that these guys, I have bet that this is the kind of opportunity that these guys will be making money in when you'll really be needing it again.
I wanted to quickly ask you about the European expansion for our folks from Europe, because now DBMF is launching a UCITS compliant version in Europe. And could you tell us if this European version is just 100% clone of what we see in the United States, or maybe there's a difference between these two ETFs?
We are part owned by a French firm called IM Global. They have a Luxembourg-based CCAV and an asset management platform in the US. In 2019, when we launched an ETF around the strategy in the US, we partnered with them. In early 2023, we partnered with them again to bring the identical strategy to Europe. And then they recently launched the ETF version of the same strategy, but in Europe. If anybody's interested in talking to them about it, I ask you to contact them directly because we serve as the sub-advisor. They set it up. It's imgp.com if you want to find them.
Right.
In terms of the broader rationale for it, distribution in Europe is extremely complicated and can be extremely inefficient. And so there has been a lot of feedback from people over time that I like the strategy. And even though it's in a UCITS, it's hard for me to invest in it. And the reasons can be, things as arcane as I'm an investor in France and it doesn't happen to be on the platform through which I manage my retirement assets or something. And so again, it generally it hasn't been as much large investors who, if they want to make big allocations, can kind of figure it out. It's been more of just this is what we got into this business to begin with, is how do we make it accessible to a broader range of people? And the question was often, can't you just do it in an ETF? So I can buy it in my account the same way that I'd buy other stocks. In response to that, our partners have now brought an ETF version of it to market. It's first trading in Paris, then it'll trade in London shortly. And again, this is the first active managed futures ETF. I think JP Morgan had one at one point, but it's essentially the first managed futures ETF. And what we'll see, this will be a great opportunity to test how many people fit into that category. And also, are there structural issues that become more apparent as you go out and talk to people? For instance, in the US, the ETF that we manage there is large. It's above $1 billion. There are huge parts of the market that cannot invest in the ETF. Take a platform like Merrill Lynch or UBS, Wells Fargo, tens of thousands of advisors. My sister can buy the ETF in her, Robinhood account or whatever she has. It's not an issue. But God forbid a sophisticated advisor at one of these platforms would want to put their sophisticated clients into a product that's outperformed most hedge funds with lower fees and daily liquidity in ETF because their centralized research department hasn't gotten around to considering whether they want to approve it or not. So distribution is often, in theory, even with an ETF, you think everyone should be able to buy it. But then what you find out is that there are all these gated communities where people actually, everyone wants to find ways to create the gates and take tolls along the way. So this, we think, is part of a great experiment to really test how much the ETF structure brings in investors who, for whatever reasons, are disinclined to invest in a UCITS fund.
A nice addition to this UCITS version of ETF I see is that it accumulates the dividends, which means that for most of the countries in Europe, there is no trigger for tax event. So probably that's also something interesting for the European folks. But to be honest, it has to be checked on a country-to-country basis.
And I'm the last person to give anybody tax advice on anything, especially in Europe. But I think the point is that every jurisdiction, every tax regime, every the landscape or the structure of the plumbing of the asset management, it's different everywhere. And so I think, what you've seen with the proliferation of ETFs, right? That is a technology revolution. Getting an ETF up and running in the US and getting an ETF up and running in Europe, everything's more complicated in Europe, but it's the fact that it's become so easy and relatively low cost to do it. My guess is it's probably 1/10 of the cost that it used to be. The fact that you can do it means that you don't need to offer a single ETF and hope everybody buys it. You don't need an S&P 500 ETF. You could, in fact, have 3 or 4 or 5 different ETF versions. One could be the normal version. There could be another version that meets other investor criteria. You could, and so I think that's something I've tried to emphasize to people, is that the ETF market in the US is $10+ trillion, but you can have a product success that's huge by any standard. Buffered ETFs, $100 billion category, and yet it's a niche product. I mean, it's really not it's not going to overtake the S&P 500 in people's allocations. But the thing is you've got to listen to people on the other side of the table. Okay, even if they like the investment strategy, what makes it difficult for them to invest? Because our job is not just to create good products. It's to make the allocator's life as easy as possible in terms of everything from the structural issues about how do you get the right access point to how do you talk about a strategy like this in a way that will make their clients happy it's in their portfolio? How do you update them on performance over time? How do you, what are the mistakes that people have made in doing that? And so the more we become almost like a holistic coach to advisors who we know are motivated to find ways to bring more diversification into their portfolio, the measure of success will be not just to create a product and hope they buy it.
Okay. I have a closing question. Maybe it will be a bit difficult, but given the current heightened geopolitical uncertainty and potential global shifts, do you maybe see this environment as an opportunity or maybe a threat for what we discussed here, the managed future strategies? How might trend following, for example, approaches perform during periods of significant global changes or increased market volatility?
Short answer is both, right? So it's so there are two things that move prices over time. Okay, so you and I stand here today, and we have perfect information, and we price every asset in the world down to 2 decimal places today. In 6 months, we're still going to be wrong on everything, right? And why, right? Because one is the information is going to be different. So inflation coming back, the information was different. The fragility of the global banking system during the GFC, that was new information. The cascading effects that these interlinkages that infected the global banking chain, the magnitude of the way in which .com stocks have been hyped versus the economic reality of how long it was going to take to realize these dreams. Okay, that was real information that came into the markets over some period of time. So on the information side, it's got to be an incredible opportunity, right? Because we have things that people have taken for granted for 50, 60, 70 years that are being thrown up in the air. The old playbook is being torn up around geopolitical relations, tariffs, and what that's going to do to inflation, the role of the government in the US economy. All these things are going to be huge. So no one knows where it's going to be in 3 years or 5 years, but there's going to be a lot of change. So the spectrum of outcomes has widened. That is a huge problem, a much bigger problem for the investors that I've described who don't adapt. Because if there's a bond market tantrum and inflation goes back to 8%, everybody who was betting every year that bonds were going to come back, and we're going to have a return to normalcy, will once again look wrong. Okay. Where it's going to be very difficult is the other thing that changes prices is sentiment. And sentiment is not what I would call like these changes in information. It's because people are rushing in and out of things. And so take last year, hedge funds got the Trump trade really early. While people were still had a very, very different view of it. Back in the first quarter of 2024, hedge funds, including managed futures funds, started to realize that, okay, Trump getting elected is going to be very good for equities from deregulation. It's going to be probably bad for bonds because inflation is going to be sticky, or you'll have a bond market tantrum. It's going to be good for the dollar. It's going to be good for gold. And so they had all these bets. And those bets would have largely worked out throughout the course of the year. The problem was that sentiment kept whipsawed back and forth. We went from, the Fed came out, Bank of Japan, this big macro unwind happened in July into early August. And then Trump's coming back, and then it kind of reverses, and finally comes back. So those kinds of, sharp oscillations every 2 months is very, very hard for anybody to trade. It's not just a hedge fund thing. Look at the past month, right? I mean, until February 19th, there was a view that, it was U.S. dominance, and and people were looking at the upside of cutting government spending and all the, it was very, very favorable view. And then all of a sudden, tariff wars with our allies and everything comes into view, and people spend the next several weeks saying, oh my God, maybe we got everything wrong. Maybe we're going into a recession after all. Maybe the Trump administration wants a recession because it'll drive down rates and allow that. I mean, people are very emotional and they go all the other end. And here we are a week after the bottom, and it's like, oh, okay, maybe this was just another one of those big head fakes. That's going to be hard. And so how those play out is going to determine where we have a lot more years. Like for us, last year was a very good year. This year we're down a little bit. 2022 was an incredible year. It was all about the change in information, overwhelmed the shifts in sentiment. But how those two balance out over time is going to matter. But what I would say is that in the event that the change of information is the one that's the really big thing, the really big driver of prices, you want the strategy. That is what the strategy excels at. So I wish I had a crystal ball and I could tell you exactly what was going to happen. But I think that when you compare this to the late 2010s, where it was actually, there wasn't, everything was kind of kept within a range between Powell and central banks and everything. That was a very, very low alpha period for the space. You're clearly seeing a more interesting environment now.
Well, Andrew, it's been an absolute pleasure having you on the podcast. Your insights into managed futures have been truly enlightening, so thank you very much for this. I'm sure our listeners have gained a wealth of knowledge from this conversation today. And to our wonderful audience, don't forget to check out also etfatlas.com for all your ETF needs. Remember that whether you're bullish, bearish, or just plain confused, ETF Atlas has got you covered. And until next time, keep riding those trends, and may your futures always be managed. Thank you.
Thank you so much. It's great being here.
Thank you.